and good afternoon. I'm Kim Rubin, Saul Price Fellow of the Tax Policy Center and Director of the State and Local Finance Initiative at the Urban Institute. It is my great pleasure to welcome you here today as tax season gets underway to be part of an important conversation focused on the role tax credits play in helping to support low and moderate income families. The EITC and CTC help sustain these families, but the actual size of the credit is affected by family structure and how much is earned during the year. I volunteer to do taxes each year and get to see how important these credits are, and then sometimes need to explain why the size of the credit and a family's refund might not be what they were expecting. Changing federal and state policy over the last few years have generally made them more generous, but have also made this more complicated. Elaine Mogg will set the stage and discuss the findings from a new paper we just released, highlighting how changes over time can affect the size of these credits. And then we have an excellent panel to discuss the challenges and opportunities involved in distributing these benefits throughout the tax code. We'd also like to thank Intuit for financial support for this work. But as with all our work, the findings are our own and independent of our funders. First, some quick housekeeping. This virtual event is being recorded and will be posted online afterward. There are bios for our panelists on the events page. All participants are muted, but please type your questions or comments into the Q&A box at any time. We'll be reviewing these throughout the broadcast and are leaving time at the end for panelists to respond. While captions are on, you can hide them or adjust settings with the live transcript button. We encourage everyone in the audience to continue today's dialogue by sharing your thoughts or observations on social media using the hashtag #LiveAtUrban. Finally, we would appreciate it if you could take a few minutes and complete the post-event survey. Thanks for joining us. And now I'd like to introduce Derek Plummer, Director of Corporate Communications from Intuit, who will be moderating this discussion and will introduce the rest of the panel. Welcome.
Thank you so much, Kim, and thank you everyone for joining us. Good afternoon or good morning, wherever you may be joining us, and welcome to our event hosted by the Tax Policy Center. As I'm sure you all know, the Urban-Brookings Tax Policy Center produces independent, timely, and accessible analysis of current and longer-term tax issues, with the goal to really help the public, the media, and policymakers make informed decisions about critical fiscal issues and support better policy outcomes. And so I'm extremely excited to be here with you today as your moderator. Intuit is a proud supporter of the Tax Policy Center with a rich and proud history of supporting independent tax research, particularly where it can inform, better policymaking and a simpler and fairer tax code. The research we're about to discuss is in many ways an update to the earlier research conducted by the Tax Policy Center and supported by Intuit to better understand how changing family dynamics, income volatility, impact two vitally important tax credits, namely the Earned Income Tax Credit, or EITC, and the Child Tax Credit, or CTC. As I'm sure everyone listening and watching today knows, both of those together have lifted more children from poverty than any other income support program in the country. Yet, I do not believe that anyone, including the Congress, the IRS, and the beneficiaries, and the experts and advocates gathered here today, is fully satisfied with the way these credits are currently functioning. So, it is our hope that this type of independent, authoritative research can better inform our policy making and ultimately improve the experience and outcomes for tens of millions of Americans these tax benefits are intended to help. To that extent, that Intuit can support this kind of research and help convene these types of discussions, we are pleased and privileged to do so. And so with that, let me turn it over to Elaine. Elaine, love for you just to kind of talk to us about this this research paper. And again, as Kim said, Elaine is the principal author of the research we will be discussing. Elaine?
Thanks so much, Derek. This work was done with research assistant Lillian Hunter Research Associate Nikki Airy here at the Tax Policy Center, and I, of course, extend my thanks to them. I wanted to start out by giving a little bit of context about how the child tax credit and the earned income tax credit work, and then explain what makes it so difficult for families to claim these credits. And then the focus of this research is trying to understand how are those credits changing from one year to the next, to sort of get a better handle on, can families predict their credits? Could the IRS predict their credits? Questions of that nature. So the earned income tax credit is a tax credit that is primarily designed to support working families with children. There's a small credit that goes to adults without custodial children, but today we'll be talking about the piece that goes to families with children. So the credit, as soon as you begin earning money, begins to phase in. It phases in faster at a higher rate for larger families than smaller families. Once it reaches the maximum credit, it stays at that maximum, which is anywhere from about $3,500 to $6,000. And then it'll phase out as earnings again increase. The child tax credit is essentially the same, but covers a much broader population. The earned income tax credit touches about 79% of low-income families with children each year, but only about 40% of all families, because benefits are quite concentrated. The child tax credit, on the other hand, touches 90% of families with children. The way the credit works is, instead of beginning to phase in with the first dollar of earnings, you need to earn $2,500. After that, for each additional dollar you earn, you can get a credit of 15 cents until you reach what we call the maximum amount of the credit that can be received as a tax refund. When our research was being conducted, that number was $1,400. It's increased a little bit since then. People get that maximum credit until they start to owe taxes, and then the credit offsets taxes owed until you reach $2,000 per family. The Tax Policy Center estimate that there's about 19% of children that live in families that don't receive their full CTC because their parents don't earn enough. And so there's a fair number of children that aren't receiving that maximum $2,000 benefit. Once you reach that $2,000, you continue to get $2,000 per child until a single parent earns $200,000 or a married couple earns $400,000, and then it begins to phase out. That's why such a large swath of the population receives the credit each year. So what makes tax filing difficult for families with respect to these credits? The first is that you need to know where your child is going to live for the majority of the year. So in the case where a family is a married couple with only biological children, the answer is often fairly simple. It's in the same household as the two adults who will file jointly and claim those children. That's about 35% of all tax returns are filed by married couples. Many more returns are filed by single people, and about 10% of all returns are what we call head of household returns. So it's a single parent household. Now, many of these children that are in single parent households are actually in shared custody arrangements. They're moving from home to home, and more importantly, they're being supported by more than one person. But only one person may claim the credit, even if tax units, multiple tax units, are providing substantial support. Over half of divorces result in shared custody. So as marriage rates, are lower than they used to be, and divorce continues to increase as a social phenomenon, we know these types of families will increase in the future and will continue to create issues for families. It's important to note there's no administrative data that can be relied on to figure out where a child lives. That's very different than your income, where most people's income is reported to the IRS from an employer. Treasury has estimated that about 70% of errors that happen on earned income tax credit return stem from the incorrect person claiming the child, though it's often a person who is supporting the child. So what we did is we looked at what happens from one year to the next. So for context, if you're a family with children and your income is below poverty, the Earned income tax credit boosts your annual income by about 16% on average, and your child tax credit adds another 6%. So this is a relatively large amount of annual income coming to you at one time as a tax refund. If you're in the group of families with income between poverty and twice poverty, so a little higher up, those credits account for about 14% of all income, so still a substantial amount. If you're married, you file a joint return typically in order to be eligible for the EITC, you need to do that. And if you're a single parent, you'll file this head of household return if the child is living with you the majority of the year. Parents have difficulty figuring out which return the child should be on, and it can create difficulties also in not just figuring out after the tax year has ended, but in thinking about what tax benefits will I be eligible for next year if you don't know what the child's custodial situation will be. So I did research with Teresa Anderson, Heather Hahn, and others, and we asked families if they knew what happened at tax time, and essentially tax time can be a mystery. So the people understand that when they work, they get larger credits. They understand that this can be a significant amount of income, but pinpointing how much income is quite difficult for families. And that's been shown in other research as well. We took data where we were able to look at families and their incomes in 1 year, and then again in the next year. And we used those data to estimate people's taxes and their tax credits. And what we learned is that about 40% of families that receive the EITC in the first year will see their credit drop by at least $500 when we see them the next year. Most of the time, it's because their earnings have risen. And so they've moved along that structure where they have received the maximum benefit and they receive less than the maximum. After the remaining drops happen occasionally because income drops, you become eligible for less credit, or because a child either ages out of the credit or is no longer in your custody. And then the number of children you're basing the credit on reduces. The child tax credit looks a little bit different. There we find that about half of low-income families see no change in their EITC of more than $500 from 1 year to the next. But in about 20% of families, they can anticipate their credit will drop by at least 50%, but by at least $500. But unlike the earned income tax credit, which is highly influenced by a family's earnings when the credit's dropped, family changes account for most of the drops in the child tax credit. It's just that 1 year you had 1 or 2 children that you could claim, and the next year you had 0 or 1 children. And so that these family changes are driving a lot of the changes in the decreases to the child tax credit. The increases to the child tax credit are still driven by these income changes. Families become eligible for more credit as their income phases in. Among low-income families, we see these credit increases are when people begin to owe taxes, and they can use that credit to offset tax liability. So I'm concerned mostly with families who experience drops in credits rather than increases, with the thinking being that these can create negative surprises at tax time. We know from a plethora of research that the tax credits enable families to make ends meet. If you have a college-age student, your child's more likely to enroll in college if there's been a relatively large refund received in April, and that makes sense. I'm in the middle of college decision-making process in my house, and your income, if you get a nice boost at tax time, might make it easier to say to go to college. Families also use these credits, though, to pay for healthcare. We notice the month people get their refunds, they're more likely to go to visit the doctor. And there's also research by the Fed that shows people are using these credits to pay for food and other items that you think of as monthly items, and they're paying down debt with the credits as well. So there's some notion that it might be important for families to see the credits delivered in advance of receiving the tax refund instead of all at once. And that's sort of what this research tries to help understand. Will people be able to predict their credits accurately, or will we risk putting people in a position where they'll need to pay money that's been advanced back, which can be a difficult situation for families. So with that, I'll turn it over back to Derek and the rest of the panel.
Thank you so much, Elaine. And I'd like to bring in other members of the panel. Pinar, income changes are an important driver of changes in tax credits. What is driving those income changes from one year to the next? And do we anticipate incomes will be more or less stable from one year to the next or in the future?
First of all, thank you for inviting me to be a panelist, and I would like to thank Elaine and her co-authors about this wonderful work, because it's not only shedding light on low-income individuals, but also it's giving us some indication about other policy issues and tax administration in the future, how we can handle those things and how we should think about that. Regarding the income fluctuations from year to year, this is not a new phenomenon. When you look at it, there's, I think, various studies that looks at the income volatility increasing since 1970s, especially at the lower end income level and the higher income levels. Obviously, we are not concerned about the higher income levels. We're more concerned about the lower income levels because, again, as Elaine said, and also Federal Reserve data shows 60% of the Americans are not prepared for any unexpected expense of between 500 and 1,000, according to the most recent data. So it's important to have a stable income, and it's very also important for the lower income individuals to have the enough income to stabilize their incomes from year to year and plan for the future, and obviously for the present as well. Why fluctuating? Why we're seeing, especially at the lower end, incomes changing. Majority of the things are driven by the technology and how technology basically got into our work lives and how it started shaping the definition of the work and the preferences of the workers. For example, jobs are changing. I think there was one data that I have seen, I think it was from World Economic Forum, that they were saying that 85% of the jobs in the future in 2030 doesn't exist today. So everything now is taking a different shape. When you ask, for example, my daughter is 7 years old and her classmates, what do you want to be? Their response is YouTuber. I don't think that anyone would expect that. Jobs are changing, and that's driven by the economy and technology. It's coming from both employee and employer side, and there are multiple reasons why that's happening. We talked about automation. There's studies out there that automation driven by the technology is basically encouraging people to switch from the traditional jobs that are basically paid by W-2s towards more alternative job arrangements. They are independent contractors, gig workers, and things like that we are seeing today. Some employers are looking into cost reduction and access to a wider talent pool. So they prefer to work with the workers in the more alternative arrangement side. And workers also like it because there's flexibility and independence. So we are basically seeing this rise in what's so-called gig economy. And by the way, I'm using the general term of gig economy because there is no agreement in the definition. And that means that it's very hard to measure its impact. But the estimates range from 3% to 40% of the workers somehow being involved with the gig economy. And these works by nature, they're short-term, some of them are project-based. That means it's making predictions of the income much more difficult. And also the recent spike in inflation also encouraged people to get involved with the more gig economy. I think it was 58, the surveys were showing that 58% of the individuals were talking about now getting more involved with the gig economy. And one last thing why we're seeing the fluctuations, I would like to underline that majority of the people in the gig economy side, they're not using that as their sole income. In fact, I think according to some data, at least 70% of the people have full-time and part-time jobs. They're just supporting their main income with the gig work. And we know that majority of the fluctuations basically come from those second jobs.
So, and Josh, I'm going to bring you to this conversation momentarily, but Pilar, you raised a couple of interesting things. You know, one of the enduring myths about tax time is that like most low-income people have simple tax returns, when in fact, this research shows that more than 30 million families that rely on the EITC confront a considerable amount of complexity at tax time due to their income volatility and shifting family dynamics. At the same time, we know it's not possible for the IRS to obtain like this information other than directly from taxpayers. So my follow-up question to what you just said is there an administrative solution to reducing this complexity for EITC recipients, or do we need to change the tax code with respect to this credit?
That's a very difficult question, because then you have to go to the basis of the US tax code. And I think that's a very difficult thing to change. We want to help the people. We would like to simplify the tax code. But at the current point, I really do not know how we can simplify without having an overall tax reform to help the people. But Elaine is an expert. Probably she will have some suggestions on that.
Elaine, you want to chime in before I ask Josh a question?
So, I mean, one thing we can do with these credits is improve reporting. So if there's additional information reporting that can help the IRS administer programs, it can also help individuals understand what their income is. We could also think about simplifying the definition of who belongs in your tax unit. So, you know, there with the earned income tax credit, if the parent wishes to claim the child, they sort of have first dibs. But if you're in a multi-generational household and maybe a grandparent is actually providing support, if that grandparent has higher AGI, they can claim the credit. So we can try to think about, you know, maybe loosening up who is eligible to claim the child. Maybe if there's a shared custody arrangement, either parent can claim the child as long as only one does. But these are complicated questions that, you know, are very difficult to legislate too.
So, all right, switching gears a little bit. Josh, welcome. So glad to have you. Quick question for you. You know, tax credits are becoming more, not less important for families with children. Several states are advancing credits. Could you talk about what's happening at the states and whether you think this volatility will become more or less important in coming years?
Yeah, thank you. Yeah, so Elaine and her co-authors hit on something really important here. And I think what we're seeing in the states shows the problem is actually probably a lot bigger than we think it is if we think about what states are doing with their tax credits relative to the federal government. So we know about 28 states have their own earned income tax credit. Another 30-something have a child and dependent care credit. Another 20 have a non-refundable or fully refundable child tax credit. And for those first two tax credits, they're typically working off the federal tax code. So it might be a tax credit worth 25% of the earned income tax credit, or if they claim it on the federal, it'll be a portion of that for their state benefit. And one of the problems you might see there is that sort of is going to, you know, increase that volatility if they're making X% on top of that, and they're having those phase-ins, those phase-outs. It's going to be a bit more complex for families, and that's something I don't think we've paid a lot of attention to, because states tend to rely on the federal government. They think something is working. They tend to mirror that. We're seeing that move away a little bit with child tax credits after the 2017 tax reforms. States that had exemptions converted them to credits. In some cases, they were non-refundable, but they stay similar regardless of what happens at the federal level. And I think this is a good thing. Even more recently, we've had states do fully refundable credits, which means families can claim them whether or not they have any income. But those vary a whole lot. And I think how they vary is pretty important. So I'm up here in Massachusetts. What we did was we have a universal dependent credit. It's worth about $180. And it's the same regardless of your income. So any worries about income volatility, If I make 0 today or this year, I get 180. If I make 100,000 next year, I get 180. And I think that's really, really good for simplicity. That's something we should be striving for. And there was a proposal out here today in Massachusetts to increase that to $600. And I think that's fantastic. And that's the right route to go. It varies in terms of phase out thresholds and phase out amounts across different states. So Vermont is another one that has a really good child tax credit for children under 6 or under 5. It's worth $1,000. It's a big amount, but it doesn't start phasing out till $125,000 in income. And even then, it's only at a 2% phase out rate. So families in that region are going to have a lot easier time figuring out what this means for their family with income changes. And if it does change a little bit, families making $150,000, they can handle that a lot better than a family making $25,000 a year. At the other end of the spectrum, we have like California's Young Child Tax Credit. It's $1,000. It's great, but it's per family, and it phases out between $25,000 and $30,000. So that's a huge dip for a small amount of income. And some of what Pinar said with gig economy, you could imagine a family making $25,000, do a little gig economy work on the side, make $5,000, but then realize they've lost $1,000 in this young child tax credit. So this can be really complex. So I think one of the key things is we want to figure out what's working and have states move in that direction and sort of not double down because some of these other policies have been done before.
Yeah. Josh, sticking with you for a moment, and you touched on this a little bit. Could you talk about like what are the design issues that kind of contribute to, tax credits being difficult to predict? Again, you kind of talked about some of this in terms of gig economy, but love for you to elaborate on that a little bit.
Yeah. So what we see at the state level, a lot of it comes from the federal level. And one of the big issues is that the U.S. is unique in 2 respects. One, we don't have a fully refundable child tax credits. Most of the countries, it's flat, universal, per child. And that makes it a lot easier. It gets us away from those issues with phase-ins, phase-outs. It's sort of like the Massachusetts model. Most other countries have always had it. And that's ideal. The second one was with our earned income tax credit. In other countries, it's typically based per worker or per family, and it doesn't vary with the number of children. Here, we've sort of built our child benefit into our earned income tax credit. So you get a lot more variation depending on the number of children, the maximum amount of the credit. And I usually use Canada as an example here. In Canada, it's 1 to 2,000, smaller phase-ins, smaller phase-outs. Here, it's anywhere from almost 4,000 to almost 7,500, depending on the number of children. Different phase-outs and usually much stronger phase-outs. So one thing that I might think about is the taxpayer advocate has been talking about this for, I think, almost a decade now, is you want an in-work credit, right? Something to incentivize work and to help low-income workers. And you want a child credit or some sort of dependent family credit. We have those all mixed up. If we could separate those, I think it's going to help deal with some of the issues we've been talking about with that income volatility.
Fantastic.
I just want to add on to that a little bit. There's, the taxpayer advocates report is, super excellent in respect to this that, discusses separating it out. It's not particularly difficult to administer a work-based credit, particularly if you do it. You could even do it on individual earnings because most of those earnings are reported. So it doesn't create a lot of difficulties for the tax filer. It's the introduction of children and figuring out where they belong that makes things more difficult. So we could improve compliance radically by just focusing on work in the worker credit. So avoid all of the confusion that relates to family status.
Elaine, I want to actually ask you a follow-up question, right? So it's pretty clear from your research that the current method of administering the EITC credit once annually based on individual tax return works against the notion of helping people meet their monthly expenses with a predictable and reliable benefit. How might the credit be administered differently while still remaining, I think, faithful to the original intent rewarding work.
So in the end of 2021, we had a monthly payment of the child tax credit. It happened for 6 months, and we saw, a lot of benefits quite quickly. We saw food insecurity drop. People were using their monthly payments to pay monthly obligations. People also reported they were using the monthly payments to pay down debts and meet regular monthly bills. We did some work at the Urban Institute where we surveyed people at the time of the credits. Do you like monthly payments? Do you not like monthly payments? And I'll give you a little background on why. But the majority of families indicated that they either had no preference or preferred a monthly payment. There's some people who still prefer the annual payment. And so as with the payments we had in 2021, I would always recommend there's an opt-out ability, although I'll caveat that by saying very, very few people used the IRS's portal to opt out of these payments in the past. So it's, I think people new to the debate wonder, well, why is this even a question of whether we should do this monthly or annually? And the reason there's a debate is because we have a history of monthly or quarterly or monthly payments not working very well. So a long time ago, the earned income tax credit, families could opt to get that in advance of filing a tax return. The problem was it was administered through your employer, and it turns out many employers did not let their employees know this existed. We had very, very low participation, like 3% of people actually participated. And I think a lot of people took that as a sign that people like those big tax refunds and they like the annual payment. But a lot of the pieces that maybe created frictions in the prior iteration of the earned income tax credit being advanced were removed in the child tax credit. Families got it automatically. It was operated by the government. It wasn't opt-in, it was opt-out. And all of these made it so people took the credit. There's also work done over the years on demonstration projects that showed once people experienced monthly or quarterly payments, they liked those monthly or quarterly payments. So I think it's important to say, we have these data that suggest the IRS does in fact know how to deliver monthly payments. They did it quite successfully. And people liked those monthly payments. It helped them meet their obligation. One of the reasons it was successful though, is that if you were low income and received a payment in error, you in general did not have to pay that payment back. Going forward, we would either need a safe harbor like that to protect families from owing payments back, or figure out something to help them pay the any errantly advanced credit out over a long period. Our research speaks to the credits are bouncing up and down from one year to the next, and there's a fair number of people who will see their credit decrease. So if we advance the credit based on your current tax return, we would make a lot of mistakes, and we either have to say we'll tolerate those mistakes by having a robust safe harbor, or we have to be very mindful that we could end up hurting low-income families if we're asking them to pay the full amount back. Because the changes are happening concurrent with other life changes, it might be unrealistic to expect people to always know to flag for the IRS, hey, there's been a custody change, please stop sending my credit. If you think about a couple going through a divorce, or maybe a child has been removed to other custody, it's already a stressful moment, and tax law is not what's on people's minds. So I think there's reason to believe people want the monthly payments. They did some good things, but it's going to be tricky, and we're going to have to be very careful if we ever advance those payments.
So I saw some head nodding and reactions from both Pinar and Josh. Would either one of you like to chime in on what Elaine just shared with us?
I think this is more like of a question for Elaine too, because with the earned income tax credit, I guess we still have a problem of only 80% of the people who are qualified for it using it. And I don't know whether we have an updated data after the 2020 and 2021 deliveries. My thinking is, and there was a new study that kind of mobilized that thinking, that was looking at increasing the self-earning report, especially at the low-income individuals, in order to take advantage of earned income tax credits. And it was released by, I think, last year, May 2020, by University of Chicago. So it is basically showing that people are aware and they started using their self-employment income in order to strategically to get in or out. Depending on where they're exactly situated in terms of qualify for earned income tax credits. So thinking about that and the new changes under the American Rescue Plan Act in terms of self-employment income reporting, the threshold being lower at 600 now. It will be interesting to see in a couple of years when that takes effect, I think in tax year 2023. How it's going to impact, especially the behavior further at the lower income level, and it's going to push that 80% higher to 85 or 90 or whatever percentage, because we will be able to pull some people in, I think.
So my own sense is that those participation rates are a little bit dampened, especially when we think about families with children. The reason I think that is because you're more likely to claim a credit if you're eligible for a larger credit than a smaller credit. So most of the folks not claiming EITC likely fall into the group of families without custodial children, and they're only eligible for up to $500. They may quite rationally decide that the expense incurred to claim the credit might not be worth the relatively small benefit that they're owed. The second thing is that studies don't account for the child maybe being claimed in another tax unit. And so it's quite possible that the number of children who are eligible for earned income tax credits is higher than that 80 to 86% number we see. They're just getting it in a different low income tax unit than the data that those studies are based on suggest is the right tax unit. But just like in our research, there's reasons to think the CPS is not exactly capturing the tax unit. We're getting a household roster at a point in time when we know we have to look back for a full year to see where kids are. The IRS estimates that are done with the Census Bureau, I think, they also base those on one of the either CPS or ACS. So I'm never too confident that that 80% is families with kids. My suspicion is that the families with children participate at a much higher rate than 80%. And I also just want to note that the share of EITC claims that are going to people with only self-employment income is a very small piece of it. So even there's been a lot of studies that suggest people's self-employment is adjusting with eligibility for the credit in some cases. It's a small slice of that overall sample.
All right, so we are getting questions populating in the Q&A section from the audience. And before I jump to those questions, I want to ask Josh one more question of you. Appropriately, the team's findings are reported in relative terms, such as percentages of the beneficiaries who are impacted by the lack of a predictable benefit. Can you help us understand what this means in terms of the actual number of American families that are impacted by the unpredictability of their income and family dynamics, and why that can adversely impact the ability to rely on these credits for support?
Yeah, so I think it's going to differ depending on sort of, as Elaine mentioned, which families it's impacting and which ones that we might have more or less concern about. So with the child tax credit, it's got a relatively high phase out rate, so there's going to be some big changes up there. But I'm less concerned about families making $400-something thousand a year. versus in that earned income credit range, where you have families struggling to go from sort of a working class lifestyle to a middle class lifestyle. And we've done a lot of work on reducing sort of those implicit marginal tax rates on low income workers, but we've just pushed them up the ladder a little bit. So I think we're seeing sort of a shift in some of the families this is affected as we've increased these tax credits, which is fabulous, but it's just a matter of tweaking them to make sure that they're impacting as few families as possible in the smallest way possible.
Thanks. All right. So, question for either Elaine or if anyone else wants to chime in. Among the solutions for the problem of the complexity in the EITC there are any specific like federal legislative fixes or proposals in Congress that could help to address these challenges. So is there anything that you're either seeing right now being proposed or think would make sense to kind of deal with that complexity?
The legislation, there's not a lot of EITC or CTC legislation that's super active right now, but that could change, of course. It was simpler when the credit was fully refundable because you didn't have to worry about an income requirement. So people who might have trouble documenting income did not have to face those issues. That is probably not a proposal that we're going to see passed in the next Congress, although I suspect it will come about. There is legislation that's expiring in 2025, the Tax Cuts and Jobs Act, and I think a lot of eyes are looking toward that. So that legislation did simplify benefits for families with children. It essentially eliminated the personal exemption for children, and the families who used to get that now get the child tax credit. So we at least knocked off a benefit, and in doing so also made it so high income families got benefits more commensurate with middle income families rather than higher benefits. So that legislation is set to expire, and I don't think there's anyone who thinks it'll just expire and nothing happen. And so I think the opportunity is to see what parts of that legislation were simplifications, and can we push it further? And my own dream is that we could give serious consideration to what Josh is talking about, these worker versus child benefits. So we could go one step further than what the Tax Cuts and Jobs Act did. That's not going to happen this year probably, although you should never predict in Congress probably. But I think there are reasonable opportunities that will come up in the near future.
As a former Hill staffer, wise words. Well, kind of keeping with the complexity question, Josh, this is to you. Another one of the challenges that is reinforced by the research is that the complexity of the current model really winds up shortchanging many beneficiaries and overcompensating others. So for those beneficiaries being shortchanged, we're clearly missing an opportunity to improve a lot of lives, lives that really could use that benefit, that rely on that benefit more than, of course, others in different tax bracket, right? So the question then is, and for those who are overcompensated, the prospect of a future like clawback of those benefits can be financially devastating. How can we correct these errors without doing harm to the families these benefits are intended to help?
Yeah, no, that's a really good question. I think it ties into some of what Elaine just said about, I think a lot about trying to right-size these credits, and almost counterintuitively, I'm a big fan of a bigger, flatter child tax credit in a sort of a smaller per worker earned income tax credit. And that deals with some of these issues in a couple of ways. One, it gets rid of this idea that there might be sort of tax bunching if you have a smaller credit, that it's harder to game the system with self-reported income if it's closer to what your combined income and payroll tax liability might be. So it takes care of that. It also helps with the issue of getting that higher take-up rate, particularly among people who don't have kids. So right now, the earned income tax credit for workers without children is very small. If we make that a lot bigger, you're going to see a lot more or a lot higher take-up rate because it's just going to be worth it to those workers. And the tough part is trying to do that and still making everybody better off without sort of breaking the bank. And that's sort of the trick of trying to say, okay, we're going to shrink the earned income tax credit. We're going to expand the child tax credit. And it's going to be nice and as flat as possible. And everyone's going to be better off. So that would be ideal, but it's really just finding sort of what that looks like and sort of how much that costs and trying to get everyone on board to do something like that. That tends to be really, really tough. And I think that's where we'll see hopefully a lot more attention paid in this Congress and the next to trying to figure out what that looks like. But I don't think folks have quite wrapped their head around the idea that, maybe the EITC should be a little bit smaller, but we're going to compensate for it elsewhere. As long as all families are better off, right? That's the direction we want to
go. Expanding the aperture a bit, question from the audience. Are there precedents in other countries for making benefits like these more predictable? Who wants to take it?
So it is true that other countries have child benefits. They're delivered monthly. Families can count on them. You'll be amazed. They can actually pick them up at post offices. It's the benefit follows the child. We are not there in the United States. I know there's a lot of people who are pushing for us to get there, but can it be done? Yes. Is it being done here? No.
And I think it also, I think it also boils down to the tax unit, right? As you mentioned, worker versus families. And I think some of the European countries are relying more on worker side rather than the families, and it's making everything a little bit more easier. And they also have, I think, targeted credits that are for specific activities associated with the children. So the question is, whether do we decide where the families spend that, or do we let the government decide where that money is spent?
So another question from the audience. How well do filers understand or not understand these credits? And did the CTC monthly payments in 2021, actually help?
There was an incredible amount of work done by the Biden administration, by community-based organizations, by researchers, many, many people when the advanced monthly child tax credit existed. The rules were much clearer. If your child has an SSN, you can get the credit. And we did surveys where, the people who were initially left out of the credit are probably who you would expect. Very, very low income families who do not traditionally have a relationship with the IRS. Families where, English is not the primary language at home. The tax system is already confusing. Add to that, maybe not having literature in the language you need creates another barrier. Families of mixed status, and by that I mean, some citizens, some, maybe there's a refugee, maybe there's someone who is, here on a temporary visa. Like all of those things, make tax filing very difficult. And a lot of those barriers were removed. And what we saw is over the course of those 6 months of payments, take-up actually increased quite a lot, particularly in the Hispanic community. So that was a big win and is a good example of how we can actually improve participation in tax credits. But it took a lot of people working in communities. There's just a plethora of studies, including some at the Urban Institute, that show it takes a trusted advisor. It's a really nutty thing to think that an agency that's most known for enforcement is going to be the right person to go out and say, no, there's benefits available. And to that, the taxpayer advocate, the former taxpayer advocate, has advocated, on multiple occasions that we ought to have the IRS staffed with social workers and people used to sorting out complex family issues. I spoke with some revenue administrators in Canada, and it was totally remarkable. There's units just dedicated to going out to communities that they know aren't receiving benefits they're eligible for and communicating that they're eligible for benefits. So these, we have to build trust with the agency delivering the benefits and the families. And in lieu of that, we were pretty successful when people that were trusted in communities were called on, to explain the new benefit to, communities that get marginalized all the time. So, we can do it. And there's, sort of roadmaps out there on even how to do it in the future.
And if I can add, I think the last year's efforts look especially impressive when you think about the fact that for most folks, it's perceived as sort of a one-time benefit, and that outreach worked that one time. But you could imagine with a permanent benefit, right? Now each year you're able to do more outreach with less time because people already know about it. They know it's time to file X, Y, and Z. So I think the IRS did a great job. It had been done permanently, then it's going to get a lot easier from here on out. So these are sort of high startup costs. They met them. But going forward, you would expect uptake to keep increasing with less outreach.
Sorry. There's a lot of, talk out there that people get really frustrated when business taxes are uncertain and people don't know what they can count. Businesses don't know what they can count on. And we ought to be talking about, families matter too. It ought to be certain for families as well. It's just as important in a family budget as in a company budget. And so I just really agree with what Josh is saying. Like, it should be predictable and we shouldn't be yanking benefits away from people, particularly after all that work was done.
Pinar, are you going to chime in?
Sure, and I commend IRS's administration of that child tax credit. I think it was a beautiful use of behavioral economics, and we are seeing that in every aspect of the field. And I completely agree. Like, for example, when you look into the expansion of the retirement accounts, private retirement accounts, that your colleagues help you to get into those things because they nudge you and they encourage you. I think the same thing has happened with the child tax credit. And I think that first credit probably will mobilize more people to go after because they know that something exists out there and they can reach out to their trusted advisors and try to get that again the next year and the next year.
I already see in my head the next panel related to this topic. All right. Time flies when you're having fun. I do have a couple more questions. So, in the vein of how can Congress make this work better? The premium tax credit, right, has a quote unquote safe harbor, softening the blow from paying back the full amount claimed through the Affordable Care Act. Could that be a model for the EITC or advanced CTC payback?
So it definitely can be. That's, we had a relatively generous for very low income families, safe harbor in the advanced child tax credit. We could also, take a page from the advanced earned income tax credit and not advance the full amount of credit. So, if families' credit drops by about $500, they won't owe anything because we've sort of held that back from being advanced. There's also, we could think about, if you owe money to the IRS, maybe you have a few years to pay it off so we can soften the blow going forward. I think we need to get a better grip on, how many people are going to fall into each bucket. And, of course, I'm from a place that does research, so I always think more research is an excellent idea. But that, there are certainly ways we could soften the blow, and we ought to be really centering families. And, I would encourage, us to really ask families, like, what is best for you? Is it best to advance half the credit and hold back up to half the credit? Do you need the credit so much that it's better to, risk a repayment? We could involve the families we're actually trying to direct policy towards and, hopefully come up with better ideas than, maybe would percolate to the top here.
Just quick point of privilege. It's so interesting. I have family members that have benefited from it. I've seen it in my community, right? And ultimately, for so many people, whether it was, the tax credits or whether it's this tax time, the value of being able to have that predictability, the value of being able to fundamentally have just that little bit of money in your pocket, right? Literally changes lives, right? And so, point of personal privilege, I think everything that you all have talked about today is extremely important. And then, Elaine, to your last point, I think centering families around these discussions is extremely critical, right? Because they're the ones that should be benefiting from these types of tax credits. So with that, we only have 4 minutes left. And so I'd love to provide each of you all an opportunity to share any final thoughts, words, etc. Thank you all for your time. But let me just start with you, Josh, and then I'm going to go to you, Pinar, and then love for you, Elaine, to finish this out.
Yeah, no, thanks for this. I'm so glad we brought attention to this. A lot of the focus has been on sort of the size of benefits. And I think this is a really good focus on how we structure them and what this can actually mean for families in terms of volatility and planning for their own lives. So thank you.
I agree with Josh, and the data shows it too. These things are playing a key role, especially to lessen the poverty rates. I think the most recent Federal Reserve data was showing that the payments during I know there's stimulus payments in there too, but expanded child tax credit and some stuff like that pulled 9.6 million people out of poverty. They are powerful tools, and I think we need to look at them very carefully and try to direct them to the people who need them most.
And I would just thank everyone for being here today and end up where I, sort of began. The Earned Income Tax Credit and Child Tax Credit provide substantial support to low and moderate income families. They are a key part of our safety net, and over time, more of our, safety net policy has been embedded in the tax system. And as that's happened, I think it's time to rethink how we're delivering benefits. Are we delivering them in the way that's most beneficial to families? And we ought to start being really creative, not just in the ways we've talked about, thinking about monthly payments, but I also think we ought to be thinking about, should we really be only allowing, one parent to claim a child tax credit when multiple parents are providing support to that child? And I hope that there's a window in the near future that we can have discussions about, how can we administratively strengthen these credits to best support families with children?
Well, thank you all again. Fascinating, impactful, meaningful research. Would encourage everyone to visit www.taxpolicycenter.org, where you can find the study. And please don't forget to, and also you'll find the study in the chat, and please don't forget to take the survey as well. Again, thank you so much for your time, panelists. Thank you everyone for joining us, and good afternoon, and still barely good morning to those that joined us from the West Coast. All right, be well.
Yeah.